Hey everyone, welcome back to the REI Marketing Secrets Podcast. Today on the show, we have Randy Smith. And Randy, for our audience out there who's just learning about yourself for the very first time, do you mind just telling us how you got started in real estate?
Yeah, absolutely. First of all, Trevor, thanks for having me on the show. I know you and I have known each other for a couple of years now, so excited that we finally got to do this. Yeah, I got started in real estate investing like a lot of folks do. I was a high income W-2 sales guy, so I had quite a bit of autonomy and flexibility in my schedule. And I started listening to Bigger Pockets and all the other podcasts at the time, probably 6, 7 years ago now, and actually maybe longer than that. But finally made the decision that I was going to jump in. I'm based here in Phoenix, Arizona, so the long-term rental in the single-family space did not make sense, just simply because I couldn't cash flow on a single-family home here locally. So I ended up buying a couple of turnkey properties in Kansas City. I found that operator through another podcast, the Real Estate Guys radio show, and found pretty quickly that turnkey was not going to be my ideal investing strategy because I am somewhat of a control freak and wanted to be involved a little bit more. So we shifted directions and bought a handful of houses in Atlanta, leveraging the Burr strategy. And from there, we ended up jumping into passive investing because I wanted to scale and do more. And I've been in the passive investing space now for 5 plus years, I guess. four
And
years. Yeah.
yeah, and that's actually how we met, through the left field investor groups, LFI, for
Yeah.
short. And Randy and I are in a deal together with, I think there's 7 or 8 of us. I think we started off pretty strong. I think we had like 14 or 15 people, and they started to drop off one by one, but that's been good to get into that deal together. But yeah, it's funny that you mentioned turnkey. That was something that I was looking into, and I know I just had a hard time doing it. And for me, it was sometimes it was the property price, depending on how expensive it was. Where for me, coming from Massachusetts, probably similar to Arizona, the prices are they can get pretty expensive. And I see a house for 100,000, and I'm just in my mind or 75,000. I have a hard time justifying that. I'm like, is this actually going to be a good property? And then for me, looking at that too, I had a hard time where maybe the cash flow is 175 bucks a month. Let's say 200 bucks a month, 2,400 a year. Well, what happens if the dishwasher goes out, or there needs to be
Right.
a bigger expense, and I have this one property? Then pretty much my whole cash flow is going to be wiped out for the year. And then it's smart that you went to Atlanta. I like that decision to move into that market. I'm a big fan of the Southeast. Pretty much, I guess you can call them your conservative states. Different than New York when it comes to being landlord friendly. But curious how it's been passively investing on your own. Are you just on the GP side? Are you just doing LP? Or are you in a mixture of both of them on deals? Or are you going out and finding deals for different individuals? Putting together, I guess in a sense, almost like helping, let's say, a company called Rise 48 out there. Are you going out there and helping to bring capital to their deal and sort of being, I guess, what you consider a capital raiser, but also it's not like you're just raising money for them and not doing any due diligence or anything like that.
Yeah. So great question. And my journey is like most, where we started in one area and then we got educated and learned and stubbed our toes, and then we shifted direction, and we did that a number of times. What I can share is that I was shifting from the active investing. I moved over to passive investing very, very heavily as an LP investor. And I spent about 2 years investing. It was probably 12 or 15 different projects that I invested in, probably 5 or 6 operators at that point. And unfortunately, I ended up getting laid off. But the positive to this real estate investing space is that the majority of my household expenses were covered by my passive income when I got laid off. So it really gave me a lot of options that I didn't have prior to getting involved in real estate. So at that point, I was able to have the flexibility to go all in real estate investing. And I found out pretty quickly that my superpower in the space aligned really well with the capital raising aspect of the syndication model. So I had experience investing as an LP. I had very strong relationships with a handful of operators. So I started presenting those opportunities to my network, which gave me the opportunity to set up a real estate investing firm very, very quickly. and had quite a bit of success right out of the gates. So I became a very popular guy amongst operators that were looking for capital. And so, fast forward a couple of years from the layoff, I've actually placed, between me and a couple of partners, we've placed about $12 million across 16 different projects with 5 different operators. So I'm involved from a fund to fund manager standpoint, a co-GP standpoint, an LP investor, and I'm looking at doing more and more in the syndication space myself.
And what I really like about that is all your experience coming in, where you had the experience as an LP, you have the prior real estate experience that we were previously talking about. I find that sometimes folks, where they come in, they don't have necessarily the real estate experience, and they can steer people to wrong deals, where it's nice having that
Yeah.
experience where you come in and you have these different operators that are out there. When it comes to the different operators that you're looking to invest in, is there a certain asset class? Do you want to stay in multifamily, or are you open to more, say, a mobile home park or a self storage operator if it makes sense for what you're looking at?
Yeah. So as an investor myself, I really steer the offerings that I have for my investors to mirror what I have for my own personal investment experience. And that's partly selfish because I want to use the business to vet investment opportunities for myself. But really, both my investors and myself get to benefit from doing that. So, when I look at my personal portfolio, about 70% of my passive investments, and I'm an LP in about 25 projects now. About 70% of those are in multifamily, primarily B class value add in Sun states, or in the Sun Belt, or the Smile states. I've been hearing that term quite a bit lately. And then I have a short term rental fund in partnership with TechFester. I do a debt fund with a really great operator, DLP, out of Florida. And we're looking at bringing on other asset classes. I really like the mobile home space. I'm a big fan of self storage. So I think the offerings and the asset classes will continue to grow because there's just a lot of great opportunities out there. But I suspect we'll keep about 70% of our offerings similar to my portfolio in the multifamily space.
Yeah, I think that's super smart. It's almost like, no, you know the space. Why not just keep investing in there? And it's funny that you mentioned
Yeah.
TechFester. They've done a lot of cool things in the short term rental space. I guess more of a disclosure. We've been working with their team pretty much on and off for probably the last 2 years or so, getting them booked on podcasts, and it's been great seeing their growth as a company and working with. See if I want to make sure I pronounce his name right. I don't know if I ever have ever said it before, but he's been great to work with, and anyone that's looking to invest in the short term rental space or the Airbnb space. I mean, you take a look at their properties, you understand why they're successful. And it's been interesting for me working with their company, where we were working with on the back end. We worked with like the project manager to get them booked on podcasts. We worked with the person that designs the Airbnbs, the one that markets the Airbnbs. So there's a lot going on with that
Yeah.
company, but curious how your experience has been with their partnership and seeing them grow and flourish over the last couple of years.
Yeah, no, it's been a really positive experience. I know I actually got introduced to them by Sam Silverman, who I was initially introduced to Sam through my relationship with Rise 48. So I have been interacting with Sam for years, and then he became part of the team probably, I don't know, about 2 years ago now. And we started talking about a potential partnership with TechFester. And I'm one of those capital allocators, fund managers that I don't like to jump into partnerships quickly. I like to spend time on the sidelines watching them. And I was able to have numerous conversations, both in person, over the phone, and Zoom, with all of the partners, and they presented as they are, and they've shown up and followed through on everything that they've promised, and they're consistent, which I think you find in this space. People can go really strong for a year or two and show up really well, but when things get hard, they get harder and harder to get a hold of. And that is not the case with TechFester. TechFester, literally, it's funny that we're talking about this, but literally this morning I shot out a note because we just got our quarterly updates from TechFester and scheduling my call to review that in more detail with them. And literally within 2 minutes, I get a response from Sam, and we're ready to move forward. So, yeah, it's nice to be able to work with folks that have the systems and the process and the business model that supports the type of growth that I'm sure they're going to see. So,
And sort of curious on the flip side of it, when it comes to to the different sponsors and operators out there, is there any sort of ones, you don't have to name names or anything like that, not throwing anyone under the bus, but conversations you maybe had with some of the operators out there or sponsors, and you're like, I just don't feel like I'm getting a good vibe from them. I'm not going to steer any of my investor capital towards them for any sort of reason. Maybe they inexperienced, maybe the numbers don't look right. Just curious if you've come across sponsors like that, or if there's certain red flags that you've seen where you're like, I just don't get a good feeling about putting my money with this particular company.
Yeah, I mean, ultimately, due diligence is the very most important thing that you're doing as a LP investor. So, betting on the right jockeys and make sure you're placing capital with the best operators. So, my due diligence process has evolved dramatically. My very first one, I just simply invested with them because I had listened to this guy on a podcast for 3 or 4 years. And you probably all know the big tall guy with the beard and who I invested with first. And that was the extent of it. Like sure, I looked at the deck, but as an LP investor, as you're just getting started, you don't really even know what to ask. So you can spend time with them and try to get a feel for them, but until you've really done the work and had the education and the experience, you don't know. So, I often encourage folks if you literally just go out to Google and say, what are the top 50 questions that you need to ask as a passive investor? You're probably going to learn quite a bit from doing that. And at least it gives you the opportunity to have the conversation with the operator, and you can tell how they're responding to the questions that you're asking. So, as my due diligence process has continued to be refined, today I've got like this 80-point checklist that I go through when I'm doing due diligence on a deal and an operator. But it's all very similar to those early lessons, which talk a lot about track record, but then verifying track record, which is really important. So kind of one key thing that I do today that I just started doing probably 6 or 9 months ago is first and foremost, I want to know how their current portfolio is performing. And we'll have the conversation. I'll ask a number of questions, and then I'll do the follow-up where I ask to see their last 3 communications, whether they're monthly or quarterly updates that are sent to their investors, and ask them to send that to me for all of their portfolio. And some operators will balk at that. They don't want to put in the energy and effort to supply that information, or maybe there will be conflicting information from what they shared with me. So it's been a really good way for me to really get a good understanding of what's going on with their current portfolio.
And that's sort of how I felt as though when I was vetting particular sponsors and operators that I wanted to invest money with. I would get their deck, and then depending on how much I liked it, sometimes I would like it a lot, but I would also ask them, a few questions, say 3 to 5 questions, and then see how they answer those questions, and then decide how quickly do they get back to me. Are these truthful? Like, as an example, something they might have, maybe the property is 60% occupied and they expect it to be 90% occupied within 6 months. For me, maybe that number feels aggressive depending on the market that they're looking at. And I'll ask them, how did they come up with that number? Honestly, sometimes they wouldn't even respond to me. I'm like, well, that's, well, I know right then and there, I'm not going to invest with them. And I want to touch on what you mentioned earlier, talking to these sponsors and operators, where when I was first having those conversations, I didn't even know what to ask them. I don't even think I Googled any questions. I would just hop on the call with them and want to learn more about what they have offering. And then they would be like, what questions do you have for me? I don't know. What questions should I be asking you? And that definitely was a learning curve for me, was learning the different questions asked the operators and the sponsors. When you talk about track record and looking back, is it more so, let's say more so the multifamily space? Because we could look at track record, say in 2020, where almost like anyone could have bought a property and maybe, got a 2x equity multiple in 18 months? Or is it more looking at it, say, I think you mentioned it, over the last, say, 6 to 12 months now, interest rates have risen. And I understand if something would happen with the multifamily operator, or maybe they broke even on a deal, or maybe their projections came in lower. I'd rather have them be truthful and tell me that than try to paint this picture like every single deal that they've ever done has been a home run. I'm fine if you project a 2x equity multiple and all I get at the end of 5 years is my capital back, as long as I get my capital back and I can understand what happened. But when it comes to your vetting of sponsors now, is it really looking closely at like the last year or so, just given everything that's happened in the market?
Yeah, absolutely. Yeah, like as you mentioned, anybody with a pulse that owned an asset back in 18 and 19 that sold prior to 22 did fantastically well. So, um, yeah, I think it's really important to understand their total track record. Understand, I think even for those people that exited during the high times when everybody was making money, to take a look at their NOI growth. So, what type of impact did their business plan have on NOI without just these crazy rent increases as well? So. And then also there was a lot of guys that were just buying and selling assets and never executing their business plan at all. So, if they bought an asset saying that they were going to renovate 80% of the units over the course of 5 years, if they sold after two, did they actually renovate 20 or 30 or 40% of those? And if so, what type of increases did they get in their rent? So, yes, it's important to dig into that. I think even more important today is to see like, what did they learn from that process and what have they adjusted to their underwriting? What have they started to do with their loan products that they're leveraging? How are they estimating expenses today with insurance, with taxes, with the cost of personnel has shot up pretty significantly. So what are just like any underwriting review, it all comes down to the assumptions. So digging into those assumptions and just kind of having a gut check, like does it make sense that on this asset they're going to get these type of rent increases and see this type of expense growth over the next 3 to 5 years? Like that's the number one thing you got to be looking at.
Yeah, the underrating is definitely key when I'm looking at it. Doesn't make sense for what they're projecting for the rent, so that it doesn't make sense for what they're projecting, what they're going to exit their price at. Even like for me now, it's looking at how are they structuring the loan. Are they doing maybe an assumption of a loan term, which would be nice. I mean, I don't know if you have a 30-year loan at 3%. I don't know why you would sell it, but hey, if you're going to do it and someone's going to come in and assume it, then that's a good deal. But if I see a
Yeah,
deal and it's 80% LTV with bridge debt, variable rate, then I'm staying pretty far away from that
yeah,
particular deal. When it comes to going out and bringing this capital from your potential investors, is it a mixture of accredited, non-accredited, or is it more just one type of demographic? Because obviously, you can if you're looking for partners. I know you mentioned Rise 48. I don't know if they're all non-accredited deals or 506B deals, but I have seen from just being an LFI, they've had quite a
yeah.
few non-accredited. Curious how it comes when or you only look at non-accredited sponsor or operators, or is it a mixture of both depending on who has the capital?
Yeah, good question. So it started out with only 506B deals. I was only doing non-accredited, or those that would be available to both accredited and non-accredited. And then when I brought on TechFester, that was my first 506C with only accredited investors. And since then, I've brought on additional partners that allow me to do non-accreds and accreds only. So I try to do about a 50-50 mix between the deals that I'm putting in front of my investors, because a lot of my early investors and some of my newer investors today as well are non-accredited. And part of the reason why I set up this business the way that I did was that I wanted to make these types of investments available to the traditional W-2 retail investor. And a lot of those folks just simply aren't accredited for one reason or another. So I keep my minimums low at 25,000, and I have a regular flow of non-accredited investor opportunities, and I work with self-directed IRAs to make all of those options available to the newer guy that's just getting into the space. So
Yeah, I really like that, especially the 25K minimum, because a lot of the sponsors you're looking at are 50K, even up to 100K. I came across not too often, but I've come across a sponsor where it's a 1 million minimum, which is obviously quite a big bunch.
yeah,
That's probably more your institutional, your
yeah.
family offices that are investing the million into that one. When your investors are coming to you, are you vetting them as well just to make sure that, hey, if I'm going to be taking 25K from them, not that you're taking that from them, but you're placing 25K, are there money that they're not, it's not their last 25K that they have to their name, that they understand what's going on, that it's not in a, it's not, it's going to be illiquid. So it's not like the stock market. If I have it in a brokerage account, if I need that at 25K, because I was in a deal where the guy put in 300K and he basically had to dilute all of his shares to get out of the deal. And that's the first time I've ever come across that. And I was able to go in and scoop up some of that at a 10% discount.
Sure.
I tried to get at a 50% discount, but he wouldn't budge. I figured why not ask him, but that's a situation where the guy loses 30K on a deal because it's just he needed the money. Where obviously it's going to be a liquid, but yeah, when you're talking to your potential investors and speaking to them, how are you making sure or just checking in that hey, this makes sense for what they're looking to do? Because I'm assuming you don't want to get that headache of you play someone's capital and then they say a month later, hey, can I get that money back? And then
Yeah.
it's a bigger
Yep.
situation that I'm sure no one wants to deal with.
Yeah. Well, and I think the important thing here is these are amazing investment opportunities for the right type of investor, but they can be a nightmare to the wrong type of investor. So
Mm-hmm.
I have these 5 items that I cover with every investor, whether they're accredited or not accredited. And a lot of people assume accredited investors are sophisticated, but not all accredited investors are
Mm-hmm.
sophisticated investors. So I like to cover with all of my people a number of the ones that you mentioned. One, the illiquidity, like if you invest and you need the money back for something in 6, 9, 12, 18, 24 months, unfortunately, we can't give it back to you, right? Two, I want you to understand that this is 100% passive, meaning you don't have voting rights, you don't have control rights, you don't get to influence the decisions that are made on this asset. So if you're one of those guys that's a control freak and needs to be involved in everything, this probably isn't the right time of investment for you. Okay. You mentioned not taking anybody's last $25,000. And I love that you said that because I never want to take anybody's last
Mm-hmm.
$25,000. I want this to be, I joke with people and say, I never want to be a bad name in anybody's household. I don't want to be the reason why you're not going on your vacation with your kids. You're not building the addition to the house. You're not able to help your family if they need your help. So I think it's important for people to have their financial house in order, i.e., have reserve accounts, have dollars in the bank account, and be prepared if those unexpected things occur, because they do, right? Um, I always like to make sure that people understand that K1s quite often are delayed.
Mm-hmm.
It's not the goal, but if you invest enough in this space, you are going to have delayed K1s. And, it can be really uncomfortable for a single mom of two that's waiting for her $7,500 income tax return when we have to tell her you're not getting your K1 until July or August or September. So it is likely if you're investing in this space, if not the first year, certainly in subsequent years, you're going to have to actually get an extension on your taxes. And then the last thing I cover with everybody, and this is like the dreaded conversation that nobody wants to hear, but it is possible to lose all of your capital in this space. It's highly unlikely. Nobody ever plans that, but there are situations where that occurs. And if you were to lose that capital, we don't want this to have a tremendously negative impact on you and your household. So I fear that I scare some people away when I share this information, but this is the reality of the space. And if you're not comfortable with those things, then this might not be the best place for you. Being an LP investor in 25 deals myself, I have one project that I'm really concerned about that I'm not sure I'm going to get my capital back. So, what is that? 3.5% of my investments? Um, it's not a terrible thing for me, but if that 3.5% happens to be your one investment that you wrote too big of
Mm-hmm.
a check for, then it's really going to hit you. So, my strategy for my own dollars and for what I suggest to other folks is, do minimum investments across multiple assets, multiple asset classes, multiple operators, multiple deals, diversify across all of those. So any capital that's at risk could be just minimal. So that's a long answer to a short question, but those are my opinions there.
Yeah, that's spot on. I want to touch on it real quick again, but not putting all your money into one operator. I've seen this happen to some people where they put money into one operator and it's going good, and then they put more money and more money into their different deals, and then something comes up, and maybe deals 3, 4, and 5, where now 60% they could lose 60% of their money by investing in this one operator. I know for me, I went and reinvested with some of the operators I had previously, but it was more so that I've been investing with them for 2 years, and it was pretty simple. It was just a mortgage note fund, consistent distribution, so I felt confident with that. And then double dipped on another one, which is the one I was talking about, where the guy had to go and sell off his 300K worth of shares, wanted to go in and bought. I was able to buy 25K worth of that for 22.
Yeah.
5, and I had the money and I was looking to invest with another sponsor, and that deal came through. I'm like, these guys have been great to invest with, so let me do that. But even then, I never want to have more than like 10 to 15% of my money in any one sponsor, where I want to diversify unless I get a good track record. And it's like these particular, I'm investing like in that same deal where if it's this triple net lease opportunity and they have another offering, I don't know if I would want to invest in another one of their offering. Maybe I'd try a different triple net lease operator to test it out. Because again,
Yep.
the last thing you want to do is have all your eggs with this one specific operator, and then something comes up. No, that's not going to be fun for anyone. I think that was something I had to learn too on my end, was the aspect that you could lose 100% of your capital. So I think that made me like make sure that I really got to vet these sponsors that are out there that are putting together these deals where if I put 25K into Google stock, the odds of that stock going down to zero, it's pretty highly unlikely unless it's, I don't think they're going to be the next Enron. I think they seem to be a decent company.
Right. Right.
I might get big swings. Maybe the stock goes up, maybe the stock goes down, but it's probably not going to go to zero. Where in real estate, there's a potential that it could go down to zero. Again, it's very small, slim chances. The odds are that's probably not going to happen, but it just makes
Yep.
you want to vet the sponsor and operator a little bit more, just knowing that there's a potential that it could go down. But the reason I invest in real estate is because I feel as though I'm getting a better return on my money, and it's and more investing in hard assets. Where in the stock market, something can happen with Google or the market overall, like we saw a week or two ago, where the market dropped 2 or 3% because people
Mhm.
are scared that there could be a recession. The inflation numbers are maybe a little higher. They aren't sure on the Fed rate cuts. Where real estate, I just continue to get like my 8 to 9% distributions on those two deals that I mentioned. I don't have to worry about the market. So it's nice. It's nice having those both of those. But when someone does invest with your company, what does it look like from a communication standpoint? I know you mentioned TechVestor sent out those quarterly updates to you. Do you have like a webinar with your clients, or is it more just you're sending out a report based on the information that you're receiving? Just curious what someone could expect if they invested through you.
Yeah, yeah. So with me, I match the communication cadence that I get from my partners. So most of my partners do monthly updates, but I do have two now that are doing quarterly updates. So I get those out within 24 hours of when I receive them from my operators. So in addition to that, though, I do a monthly newsletter to my investors. I have regular cadence in conversation with my investors as well. I have a sales background, so I am one of those people that have a pretty strict schedule where if somebody's invested with me, they are going to hear from me at a regular interval, either via text, email, or phone call multiple times throughout the year. So I try to keep that communication open. My goal is not to have 10,000 investors. My goal is to have 1,000. And even at 1,000, that would only be 3 conversations a day if I was talking to them at least once a year. So my goal is to have an intimate group of investors that invest repeatedly, and that we can grow our wealth and grow our success together.
Yeah, that's fantastic. And let's say someone is looking to get started investing in real estate. What's the best piece of advice they think you'd want to give them?
Start. Uh, I hate to say it, like I sat on the sidelines for years and I missed out on a huge, huge opportunity. I probably could have doubled, potentially even tripled my investable capital in the time that I was sitting on the sidelines. And you can listen to books and read podcast, or listen to books, listen to podcasts, network, go to events, do all of that stuff. But the real education starts when you get a little bit of money at play. And so I would just say start small. And if you got 100 grand to invest, put 25 grand in 4 deals with a couple of different operators. And if you got to use your self-directed funds to do so, do that. But just get started. You're going to learn so much after you get some money at play in this space. And odds are you're going to end up switching directions as well. So that's not a bad thing. That's actually encouraged. If you started in one path and you kept going in that path, I think you're probably leaving opportunity on the table. So
Yeah, I really like that advice. And that was the biggest thing for me, which is, being definitely scared wiring over that first 25K. I don't
yeah,
think I ever wired money over before I did that first amount, making sure that it actually made it to its destination and the operator. And then once I did that, it was like got that first monthly distribution. I was like, oh, this is nice. And then you start to build that confidence that this could be an actual thing. And like you mentioned,
yeah.
you just have to go out there and put that money to work and get that experience. And I think that was a big thing for me. But Randy, I just wanted to say I've really enjoyed our conversation today. And if there is someone out there in our audience that is looking to learn more about you or invest with you, where should they go to?
Yeah. I spend most of my time on LinkedIn, so Randy Smith on LinkedIn, but my website is impactequity.net. My podcast is The Gentle Art of Crushing It, where we talk to existing LP investors or very large operators with huge track records. So it's just a really great place to hone your due diligence skills. And then I'm also doing capital raising coaching for those folks that are trying to get into the space and want to learn how to raise capital for either their own deals or other people's deals. So certainly reach out either through LinkedIn or my website. I'd love to chat with you.
Awesome. I'll make sure to include that into the episode's show notes. And Randy, thanks so much for coming on again.
Thanks so much, Trevor.